Okay, I'm reading, continuing in Truth in Lending, the content of disclosure statements, and I'm guessing you're talking about the Truth in Lending disclosure statement. Beginning on 8/1/15, these disclosure requirements will apply only to non-mortgage transactions and reverse mortgage loans, and that's because we're going to go with an integrated disclosure. But that's actually as of October, so we still have a few months to implement that. APR is the first and most important part of the disclosure statement, and the APR must be disclosed more conspicuously and should be described as the cost of the credit of your credit as an yearly rate. This rule will not apply to private education loans as of, I'm guessing, October 3rd of 2015. The tolerance for a correct APR is 1/8 of 1% in a regular transaction and 1/4 of 1% in an irregular transaction. An irregular transaction is one that includes one or more of the following: multiple advances, irregular payment periods, irregular payment amounts, which an irregular payment period, an example, is other than the first payment period, and an irregular payment amount is other than the first or final payment. Moving on to page 310, mortgage loans. The tolerance for the APR in a dwelling or real estate secured transaction is the same as for other transactions, except that the APR will be considered within tolerance if the finance charge is understated by no more than $100 or is overstated. As of 10/3/15, the rule will be as follows: if the APR in a transaction secured by real property or dwelling varies from the actual rate as computed under the rules, the rate will still be considered accurate. If the rate results from the disclosed finance charge, the finance charge would be considered accurate under the rules, or for the purposes of rescission, if the finance charge would be considered accurate under the rescission rules. In a transaction secured by real estate or a dwelling, in addition to the other tolerances that are applicable, if the disclosed finance charge is calculated incorrectly but is considered accurate under the disclosure rules, then the APR will be considered to be accurate. Tolerance in rescindable transactions. And this is active today. This isn't going to become effective at any particular time. This is effective today. Tolerance in rescindable transactions. In rescindable transactions, the APR and finance charge will be deemed to be correct if they are greater than the amounts required to be disclosed, or if they are understated by no more than the greater of 1/2 of 1% of the face amount of the note, or $100. In a refinancing of a residential mortgage transaction with a new creditor, if they are understated by no more than the greater of 1% of the face amount of the note, or $100. Finance charge is a Part B importance under the disclosure statements, and the finance charge must be disclosed more conspicuously and should be described as the dollar amount the credit will cost you. It does not include any charge of a type payable to a comparable cash transaction, and it must include interest, service transaction, and activity fees or fees, including charges on a checking account that exceed those in a similar account without a credit feature, such as ATM fees that exceed the charges for an account without a credit feature. Points, loan fees, assumption fees, finder's fees, and similar charges, appraisal, investigation, and credit report fees, except in a real property or residential mortgage transaction. Premiums for credit, life, accident, health, loss of income, or insurance protecting the creditor against default, unless the coverage is not required by the creditor. The consumer signs or initials the request for insurance, and the premium is disclosed. premiums for insurance against loss to property written in connection with the credit transaction. This does not include pre-existing insurance policies or policies purchased at the time of the transaction if the creditor discloses that the consumer may choose the insurer. Mortgage broker fees, even if, and these are all fees that need to go into the finance charge. Mortgage broker fees, closing agent charges, charges imposed on the creditor by a third party for purchasing the obligation if the charge is paid by the consumer either in cash as an addition to the obligation or as a deduction from the loan proceeds. Discounts for the purpose of inducing payment by other than by the use of credit, except an offer on an open-end credit plan. Charges for debt consolidation or cancellation or debt suspension contracts written in connection with the transaction, whether or not these are legally considered insurance, unless the following four things. 1. The purchase is voluntary, not required by the lender, and this fact is disclosed in writing. 2. The amount of the premium for the initial term is disclosed in writing, and if the initial term is less than the loan term, the term must also be disclosed. And 3. The consumer signs an affirmative statement requesting the insurance. And 4. In the case of a debt suspension contract, the fact that the obligation to pay principal and interest is only suspended and that interest will continue to accrue during the suspension period. And last, the finance charge must include, in the case of telephone sales of debt cancellation and debt suspension contracts, disclosures must be given orally, and the lender must maintain evidence of providing disclosures, and that the consumer affirmatively elected to purchase the insurance and mail the required disclosures by 3 business days after the purchase. Next, this section is titled Finance Charge Does Not Include, and there's a list of quite a few things here, application fees being one of them, if they are charged to all applicants whether or not credit is actually extended, late fees, overdraft fees, unless the payment of the check and the imposition of the fee were previously agreed to in writing, annual or periodic fees for participation in a credit plan, seller's points, if properly itemized and disclosed, taxes and fees required by law and paid to public officials for determining the existence of or for perfecting, releasing, or satisfying a security interest. And if properly itemized and disclosed, any premium for insurance in lieu of perfecting a security interest that does not exceed the fees for determining the existence of perfecting, releasing, or satisfying a security interest that would otherwise be payable. H, or another item not included in the finance charge, is closing agent charges unless the bank requires the service, requires the charge, or retains a portion of the charge. Voluntary debt cancellation fees, if they are not required by the vendor, are disclosed in writing and the consumer signs an affirmative request for coverage. And J, discount offered to induce payment for a purchase of cash, check, or other means. K, the following real estate related fees in a transaction secured by dwelling or in a residential mortgage transaction if the fees are bona fide and reasonable in amount, which are fees for title examination, abstract of title, title insurance, property survey, and other purposes, fees for preparing loan related documents such as deeds, mortgages, and settlement docs, notary and credit report fees, property appraisal fees, or fees for inspections to assess the value or condition of the property if the service is performed before closing, including a pest inspection or flood hazard determination, and amounts required to be paid into escrow accounts if the amounts would not otherwise be included in the finance charge. Last item not included in the finance charge is the interest forfeited as a result of an interest reduction required by law on a time deposit held as collateral. Tolerance for finance charge is within $5 or an amount financed of $1,000 or within $10 for larger transactions. The loans secured by real property or a dwelling. Tolerance for finance charge is $100 for understated finance and any amount for overstatements. Amount financed is another area within the TILA disclosure, and it's described as the amount of credit provided to you or on your behalf, and it must be computed by determining the principal loan amount, adding other amounts financed by the creditor that are not finance charges, and subtracting any prepaid finance charges, for example, points, loan origination fees, and so forth. The total of the payments, I, must be described as the amount you would have paid when you have made all scheduled payments, and generally the total of payments is the sum of the finance charge and the amount financed. The total sales price is a new section here, which is used in the credit sale, and must be described as the total price of your purchase on credit, including your down payment of blank. The payment schedule, Section F of the disclosure statement, other than for loans secured by real property or a dwelling, other than a timeshare, the payment schedule disclosure must contain the number, amount, and timing of payments scheduled to repay the loan. They must use exact amounts of payments, and if payments are owing to the application of a finance charge to the principal balance, the highest and lowest payment may be given along with the statement that other payments will vary within the range. And if the private mortgage and PMI payments are included, must reflect those payments until the date on which the creditor must automatically terminate the PMI. As of 10/3/15, the following must be disclosed. This is prepayments. If a finance charge will be computed from time to time by applying a rate to the unpaid principal balance, this statement indicating whether or not the charge will be imposed for paying all or part of a loan's principal before the date it is due, and if a finance charge does not get computed as described in one above, a statement indicating whether or not the consumer is entitled to a rebate or any of the finance charge if the obligation is prepaid in full or in part. Part of the disclosure statements now at this time is security interest, meaning that the creditor must explain that he is or it is acquiring a security interest in the property purchased as part of the transaction or in property specifically identified as part of the transaction, and if notes or documents have spreader clauses, these clauses must be disclosed. Credit, life, and health insurance. To include credit, life, and health insurance from the finance charge, the following must occur. The insurance must not be required to get the loan, and that fact must be disclosed in writing. And the borrower must indicate a desire to buy the insurance by signing and initialing an affirmative request for the policy, and the cost of the insurance for the initial term must be disclosed in writing. Variable rate disclosures, also required in the disclosure statement at this time, must be given in all transactions where the APR may increase after consummation and where the loan is not secured by the consumer's principal dwelling or is secured by the consumer's principal dwelling, but with a term of 1 year or less, and must include the circumstances under which the rate may increase, any limitation on the increase. If the loan is secured by a dwelling, there must be a limit on the interest rate that can be imposed over the life of the loan. Let's see what other pieces of information are required under the TILA disclosure as per page 313. For variable rate disclosures, there's actually a couple more pieces. 314, that is, on page 314, the very top, we have the effect of an increase and an example of payment terms that would result from an increase, and the lender may use a representative sample. Lastly, under variable rate terms, if the loan is secured by a consumer's principal dwelling for a term of greater than 1 year, an armed disclosure must include the fact that the transaction contains a variable rate and a statement that variable rate disclosures have been provided earlier. Furthermore, items to include in the TILA disclosure is assumptions, the demand feature, interest rate and payment disclosures on mortgage loans. Under assumptions, in residential mortgage transactions, disclose whether or not another borrower will be able to assume the loan on the same terms and conditions Under demand feature, if the loan has a demand feature, it must be disclosed, and if disclosures are based on an assumed one-year maturity, it must also disclose that fact. Not sure what that means, but under interest rate and payment disclosure on mortgage loans, as of 10/3/15, this disclosure will not apply to loans that are subject to early disclosures under Reg Z, Section 19E and F. These special rules require that contract interest rates and payments be disclosed in a tabular form, apply to closed-end loans that are secured by real property or a dwelling other than a timeshare. Again, these are interest rate and payment disclosures on mortgage loans under 1026.18. These interest rates and payment information must be disclosed in a prominently placed table similar to the one of the model forms in Appendix H of this reg, with no more than 5 columns in at least a 10-point font. Interest rate disclosures, A, B, and C. A, 1, fixed rate amortizing loans, the interest rate on the date of consummation must be disclosed. On amortizing ARM or step rate loans, disclose the introductory rate and monthly payment, for example, the interest rate at consummation and the time period until the first rate adjustment may appear, and to the maximum during the first 5 years, for example, the maximum rate that can be applied during the first 5 years, during the first periodic payment date and the earliest date on which it may apply, and the maximum ever, example, minimum rate that can apply during the life of the loan on the earliest date that it could apply. C, if the loan provides for payment increases, the date such increase will become effective, and the interest rate that applies, labeled as first adjustment or first increase as applicable. I just rolled right through page 314. Let me check the time.